Ever heard people say, "I own shares of XYZ company," or "I invested in stocks," and wondered, what does that even mean? Don't worry. In the next few minutes, I'll explain what a stock really is, why companies issue them, and why you should care. Stock is a unit of ownership in a company. When you buy a stock, you're literally buying a small piece of that company. Let's say a company has 1 crore shares in the market. If you buy 100 of them, you now own a fraction of that business. That means, technically you're a part owner, and now company's performance will decide your return on investment. Now let's simplify. A share is a 1 unit of stock. An equity is ownership in a company. And the shareholder is a person who owns the shares. Now understand why companies sell their shares or equity. Companies need money to grow, to launch new products, hire employees, expand to new cities, and many more expansions. They have 2 main ways to raise money. First, take a loan, debt. And second, sell shares to the public. That's called issuing stock. When a company sells its shares to the public for the first time, it's called an IPO, initial public offering. Let's understand these terminologies. Primary market is a market where new shares are issued. And secondary market is where existing shares are traded on stock exchanges. To avail this benefit, the listing of company is necessary. When the company gets listed on stock exchanges, it is called as an initial public offering, that is an IPO. Investors can apply for an IPO to avail a specific lot of shares before it gets listed on stock exchange. For example, Infosys went public in 1993. Imagine if you bought just $10,000 worth of shares back then. Today it'd be worth lakhs. There are mainly 2 ways to earn money from stocks. First is capital gain. It is when the stock price goes up and you sell it at a profit. And second is dividends. Some companies share their profits with shareholders. Investors can earn their part of profits through dividend payouts by the company. Now, what is a market price of a company? Market price is the current price of the stock being traded on the exchange. It is determined by various factors like demand and supply. Stocks are one of the most powerful ways to build wealth over time. Even small investments can grow big with time and discipline. But remember, stocks are not always provide profits. Prices go up and down based on various factors. So there's risk involved. You could lose money if the company performs badly or the market crashes. So never invest money you can't afford to lose. Do your research, or consult an advisor. You can simply subscribe us and watch these knowledgeful videos to avoid destruction of your wealth. So, concluding today's topic. A stock is ownership in a company, and the stock market is a place where that ownership is bought and sold. It's not gambling, it's understanding business value, growth, and timing. And this is just the beginning. There's a lot more to learn, like how to choose stocks, read charts, and build wealth using TechnoFunda approach. If you liked this video, hit that like button, and follow the channel for more simplified stock market lessons.